Bloomberg Audio Studios. Podcasts, radio, news.
I'm Stephanie Flanders, head of government and economics at Bloomberg, and this is Trumponomics, the podcast that looks at the economic world of Donald Trump, how he's already shaped the global economy, what on earth is going to happen next. This week, we're investigating the curious case of the everywhere, nowhere tariffs. For as long as Donald Trump has been back in the White House, everybody has been talking about his tariffs, and never more than on April 2nd, when he announced he was liberating the US economy by slapping hefty trade levies on pretty much all of America's trading partners. Since then, we've talked about the level of the tariffs, the negotiations over bringing them down. Politicians and consumers have also talked about how they are adding to inflation, especially in all those big arguments about affordability and the cost of living before and after the recent US off-year elections. The president recently has himself seemed to admit that tariffs on some key food products like beef and coffee were pushing up costs for households, and he wanted to cut them. We've also waited to see how tariffs might hit jobs and profits for American companies. But amid all this talk, we've not seen a lot of real evidence of where exactly the tariffs were hurting. And with the stock market still booming, we've not heard many businesses admit that tariffs were affecting their bottom line. Though, as you'll hear later, recent GDP revisions do suggest that US profits in the second quarter of this year did fall off a cliff. So, who has paid for the tariffs? How have they affected the US economy? And what's the evidence that they're accomplishing any or all of the president's objectives, notably cutting the trade deficit with China? They're the riddles we're hoping to solve on today's show, and we've got two great detectives to help us get to the bottom of it. Senior Fellow at the Council on Foreign Relations, Brad Setzer, my old friend. He's an expert on global trade and capital flows, and his regular blog on the CFR page is called Follow the Money. We worked together approximately 500,000 years ago, and unlike me, he then went back to the US Treasury to be Deputy Assistant Secretary for International Economics under President Obama. Brad, great to have you finally on Trumponomics.
No, it's a pleasure, and it wasn't that long ago.
We obviously both still look very youthful, but it makes me feel old.
It destroys the illusion.
Also joining us, as so often, Anna Wong, Chief US Economist for Bloomberg Economics. And before this, she worked at the Federal Reserve, the US Treasury, and on secondment at the White House Council of Economic Advisors during Donald Trump's first term. Anna, hi.
Hi, I actually also worked for Brad Setzer under Obama administration when he was Deputy Assistant Secretary. He's my old boss.
Anna, let me start with you. Just to remind us how much the average or effective tariff rate on goods coming into the US has gone up. And we've probably lost track of a lot of the negotiations and where things are. But there has been a significant increase in the level of tariffs to come into the US.
So the effective tariff rate is roughly around 14.5%, just roughly. Trump administration just announced some exemptions for food imports last Friday. So that should knock off another 0.2 percentage point from that. So you can say roughly around 14-ish%.
From memory, I think it was about 2 or 3 coming into this administration. So it's a pretty significant increase. The question I asked you last week is, who is paying for these tariffs? Where are we seeing it?
Yeah, so we look at all the data we have, which is import prices, and you reconstruct a tariff inclusive import price index. We also looked at PPI, we looked at CPI. So taking all the information together, we have come to this breakdown. It would be about 4% of the price cost borne by foreigners, 70% absorbed by any kind of intermediate firms in the U.S., and 26% absorbed by U.S. consumers through higher prices.
When you say it's that certain chunk of it has been absorbed by consumers, that 30%, we're seeing that in prices?
Yes. So we estimate that CPI and core PCE inflation is roughly 0.3 percentage point higher than it would have been without those tariffs. So most of those tariffs passed through are showing up in core goods CPI, things like house appliances, washing machines, or audio equipment, sports equipment, those type of things. And in fact, that 0.3 percentage point addition on core CPI and core PCE inflation, that's quite similar to a top-down model from the Fed too. So at the Fed, we have this back of envelope model on the impact of tariff. So a tariff hit similar to what we see right now in total would have pushed inflation up by 1.1 percentage point, roughly there, according to the Fed model, if there's 100% pass through. So if there's 0.3 or roughly 30% of the pass through, then that corresponds to roughly 0.3 percentage point addition on CPI. And that's indeed what we have seen in the year over year increase of core goods CPI. We have seen that went from negative 0.1%, that's year over year core goods CPI, to now 1.5% year over year now. That's a 1.6 percentage point swing.
And Brad, just as we'll get into some of the details, but just sort of on the broad scope of what Anna just said, that 30% absorbed by consumers, and then it looks like about 65% by those kind of intermediate firms who have to pay the tariff at the border. Is that roughly how you would look at it?
I mean, more or less, yeah. I think a lot of estimates are converging around similar numbers. You can just see from the import price data that foreigners aren't paying it. So then it's just a question of who's absorbing it in the U.S. economy. It has been a slight surprise that only roughly a third looks like it's been passed on to consumers. An unusually high fraction seems like it's been absorbed by the supply chain, by intermediate importers.
I mean, obviously at Bloomberg, we are often listening in on earnings calls when companies are announcing their results. We're tracking profits and earning revisions. And we're also keeping an eye on the stock market, which seems to have been doing pretty well. And even just in this recent earnings season, I seem to remember my colleagues talking about most companies actually beating their expectations on profits. Maybe you first, Brad. Why do you think we're not hearing so much from companies about having to take these higher prices or the tariffs in their margins?
Well, I mean, sort of one of the ironies is that the parts of the U.S. economy that generate the super profits, the tech sector, the pharmaceutical sector, they've been entirely exempted from the tariffs. Why wouldn't NVIDIA be talking about it? Because there isn't yet a tariff on chips. Why is it not impacting Pfizer's bottom line? Well, there isn't yet a tariff on pharmaceuticals. And we've had some kind of crazy fluctuations in trade because of expected tariffs on pharmaceuticals. But at the end of the day, the tariffs haven't hit those sectors. And I guess in other cases, you're seeing offsetting shocks. Like a firm like Caterpillar would normally feel the impact of the steel tariffs, would normally feel the impact of higher tariffs on parts. But there's a lot of demand for generators and for some of the equipment used to make data centers. So you kind of end up with offsetting shocks and don't have that clear impact on the bottom line. That's the best I can do. It is a bit of a mystery. It does not feel like it's been fully passed on by consumers. We know it hasn't been absorbed by importers. So it implicitly has to be impacting someone's bottom line in those sectors where there are tariffs.
Anna, what's your sense of where that, I mean, if you're saying 60% is being felt somewhere by corporate America, is this the little guy who's finding they're getting squeezed rather than these big companies we hear on the earnings calls?
Yeah, so the stock market is not the economy. It's very important to know that the S&P 500 only has about 500 firms, but the total U.S. economy has about 7 million firms.
You have that on your Twitter handle, don't you, more or less, Anna Wong, comment brackets, the stock market is not the economy.
And of which 90% of those 7 million firms have only less than 20 employees. And most US firms don't export at all either. And another very specific feature about the stock listed companies is that in total, they generate 30% of revenues from outside of the US. So offsetting shocks include, for example, the dollar depreciation this year. And that 10% dollar depreciation had boosted the revenues, foreign revenues for those S&P 500 firms.
So their profits abroad are suddenly, if you're just measuring it in the US, they're worth more.
Yes. So if you want to look at the profit situation in the rest of America, primarily these small businesses, we have to look to the national accounts. And there you see a pretty clear evidence of profit hit. So the second quarter GDP corporate profit was revised down significantly from the first estimate of roughly 65 billion to just 7 billion in the revised estimate.
65 turned into 7. I know those in that particular bit of the national accounts does sometimes jump around a lot, but is that a big revision?
That is a big revision. When you look at this, the change of corporate profits from the second quarter of 2025 compared to the end of 2024, you see that most of that decline are in manufacturing sector, wholesale trade, and transportation, warehousing, motor vehicles. So we are seeing at the aggregate level some kind of margin hits, but it's just not showing up in the stock market.
That is a very striking number. The profits having gone down from 65.5 to just under 7 billion in the second quarter. And as you pointed out, Anna, there's evidence that it's the wholesale sector. And when you look a bit deeper into the numbers, are we then likely to see if the corporate sector as a whole, even if it's these kind of smaller businesses that are a little bit below the radar, if they're the ones who are feeling the hit, are we going to see that in jobs? Is there an economic impact which we're still waiting to see from that?
Yeah, so I think we can always look at these empirical data and then go back to the theoretical models and evaluate how good or bad they were. So going back to this Fed model that internally the Division of International Finance has on the impact of tariff. In 2018, the Fed staff ran a simulation on what a 15 percentage point tariff shock would do to unemployment. And the impact depends on whether the Fed is looking through the impact on prices. So I would say in the current situation, the Fed is looking through it, somewhere in between. So according to the look-through strategy, the unemployment rate should be going up by about 0.3 to 0.5 percentage points in the first year after the shock. And I would say that's roughly where we are, because when we start the year, the Wall Street consensus for unemployment rate was about 4.1 at the end of 2025, and now we're looking at 4.5. So, in fact, these macro models are performing okay.
Brad, if you're looking at the kind of overall impact of these tariffs, they've obviously been very uncertain, unpredictable, and if we were designing a trade policy, we'd probably want, at the very least, something that was a bit more stable and followed a slightly more predictable path. But if you just were told that the effective tariff rate had gone up from 3% to around 14% over the course of 6 to 9 months, and then you looked at these various economic indicators, that change in the openness of the US economy, do you think it's had a less harmful impact than we might have predicted at the beginning of the year?
Yeah, modestly less harmful. I mean, largely because businesses have absorbed so much of the one-off shock. It hasn't been all felt by consumers. And so consumers really haven't pared back spending on other goods. Of course, part of it is also that other things are happening. But for the tariffs, the big increase in spending on data centers and all the investment in AI might have been propelling the US economy quite forward at a pretty fast clip. The strong run-up in the stock market is generating a wealth effect even now. And that is also supporting household consumption. But all told, if you said we increased tariffs by a percentage point with no offsetting policy changes, and at the end of that 6 months, consumer prices are only up 30 basis points, that's a little smaller than I would have expected. Now, I do think, and I think Jay Powell thinks as well, that we're going to see a little bit of a lagged increase in the price level. But in aggregate, it was never at this level, as opposed to the levels that came out after Liberation Day. It was never at a level that I thought was going to lead to a recession. In order to get to a recession, you needed tariffs of more like 20%, 2 percentage points of GDP taken out of the economy, and you needed no offsets, no tax cuts to put money back in. And what we have seen is compared to that giant shock, a more manageable shock, and then there have been some offsets.
It's not easy. We talked about it before on the show. It's pretty hard for politicians to raise taxes in the current environment, but the president has raised these taxes and he's made a bunch of revenues.
And he's arguably paid a bit of a political price for it. I mean, hence the fall in the price of coffee, or the tariff on coffee. Hence the decisions to exempt consumer goods that aren't made in the U.S. from some of the tariffs. Even if the aggregate impact has been somewhat more modest than might have been initially expected, it still has impacted certain very salient prices. And it certainly directionally has increased the cost of living, which is an issue here, as you know. So I wouldn't say it's been politically costless. It just hasn't pushed the economy off a generally growing trajectory.
Let's sort of change the focus a bit. I guess we should also put in a health warning. Anyone who's a dedicated listener will notice that we've resolutely not talked about the possibility that a good half of these tariffs are going to get ruled unconstitutional by the Supreme Court. The principal reason why we haven't talked about them is everybody else's. And the slightly less principled is that we just thought every time we did would be guaranteed that the moment we put it out, there would be a decision that would suddenly put everything in question. So when that happens, we will get Brad and Anna back to talk about what that means. But Brad, outside of China, I suspect you're one of a handful of people who understands the Chinese balance of payments. And you've often pointed to things that people don't want to notice or would rather go away. Of course, one of the key objectives of these tariffs was to reduce the US trade deficit and encourage American producers to make more in the US, encourage US consumers to buy more American products. I mean, it is early days, but how is that side of the agenda going?
Well, I mean, unfortunately, there's really no impact that there's been a reallocation of production back to the United States. We're just not seeing a boom in manufacturing and not a boom in the kind of manufacturing that would substitute for China. So just zero evidence, I would say, that is happening. Again, early, but zero is the right number. There was a reallocation of final assembly away from China to Southeast Asia in a quite significant way, and also to Taiwan. If you look at the latest trade numbers out of Taiwan, they're going up like crazy. And that is a function, at least in part, of doing your servers in Taiwan rather than final assembly in China. The interesting thing is that after the latest deal, the deal that was negotiated in Korea, the base tariff on China is going to come down from 30 to 20. Now, there's legacy tariffs on some goods from the Trump 1 trade case. And so in some cases, those are 25. In some cases, those are 7.5. In some cases, those are 0. But for most of the goods, the new tariffs are either going to be 27.5, which is high, or 20, which is also high. But 20 is not that different from the 19 or 20 now facing Southeast Asia. So structurally, I think there was a lot of movement out of China to do final assembly elsewhere in anticipation of a different tariff structure than has actually emerged. What has emerged, if this sticks, is a tariff structure that's too high on Southeast Asia and too low on China to generate the kind of reallocation away from China that you saw in Trump's first term. And it's still too small, particularly with the exchange rate moves, to get much production coming back to the US.
That's really interesting. I mean, I think a lot of fair-minded people will say it's pretty hard to just quickly build a factory. And so we might not see that physical production move. But I think if your main goal is to wean the US off a particular reliance on China, and that's obviously been a goal that's also carried through from the first Trump administration through the Biden years, that is a very striking conclusion from the recent trade deal. And actually, some of our geoeconomist analysts were making the same point. It seems odd to be, in effect, penalising some of the countries that are trying to compete with China, whose basket we might want to put more eggs in. But Anna, the trade deficit, is there a sense, is the composition of the trade deficit fit? I mean, have we reduced the amount of imports coming into the US with these tariffs?
I can offer a perspective on what these earning calls are saying. So Bloomberg Economics and Bloomberg Intelligence have been using AI extraction technology to extract all the tariff-related quotes from the earnings transcript so far. And what I have seen is that, number one, a theme that emerges, as Brad said, there are many other offsetting things that's happening outside of this tariff space that's helping beef up the margins of firms like AI, and also deregulations on environmental stuff, on autos. However, the second most dominant theme, I would say, is how firms mitigate these tariff costs. And I see a lot of firms mentioning sourcing, more efficient sourcing outside of China. And in fact, many of these firms are projecting forward guidance saying that in 2026, their effective tariff rate would be lower. I mean, regardless of what the statutory tariff rate is, because many of the supply chain mitigation strategies they put in this year will be in full operation next year. And all of it surrounds sourcing outside of China. And I looked at those statements and I wonder, well, but what if there's a US-China deal that lower the Chinese tariff and to below the Southeast Asia? Because many of these mitigation strategy involve moving to Southeast Asia or to the USMCA region. As of now, this positive picture partly hinges on these mitigation strategies.
That's interesting. They thought that was the one sure thing, was that they would want to be a bit less reliant on China, and then it turns out maybe they didn't need it. I am kind of intrigued. He's been so variable and unstable in his trade policies that you've told us in the past producers were possibly not raising prices because they thought, well, I might have to cut prices again. You know, they may all go away in a week's time. And at the same time, the threat of tariffs or the reality of tariffs was making them do all these cost-cutting things. If the tariffs then go away down the road, he will have helped increase the efficiency of US business, right?
Probably, but if the tariff were to suddenly go away, for example, with the Supreme Court ruling, it would be super bullish for the market. Because when you read these earning transcripts, what struck me is that had there not been tariffs, these profit margins would be through the roof. Like, even with tariffs, they're already talking about it being really good. And even Ford and GM, these big automakers, are talking about how they're finally getting to margins of 8 to 10%. And the auto sector is so resilient. In fact, for them, the tariff is creating domestic protectionism, which is benefiting them from their perspective, even though it does create more than $1 billion tariff costs for some of these auto firms. But the original intent of tariff is domestic protectionism. And some firms, for example, in auto and steel sectors, are seeing some of that.
Brad, quite a lot of voters for Donald Trump thought this was just about buying fewer goods from the rest of the world. And we have made those goods more expensive to some degree. Have we reduced the amount coming into the country? Or have the tariffs reduced the number of imports coming into the country?
I'll start with a dodge and then come back and actually answer the question. The dodge is, of course, we lack trade data for the past 2 months because the government has been shut down. The correct answer is that so far the trade deficit has not gone down. And then the further component of that answer is we've had some of the most crazy swings in the trade data in human history tied to swings in products that didn't end up having any tariffs. So we have this huge surge in gold imports in the first quarter because everybody was afraid that gold was going to get tariffed. Well, guess what? Gold didn't get hit by any tariffs. And now some of that gold's flying out of the US back to London. People were terrified that the high value-added pharmaceuticals were going to be tariffed. And that was going to undermine all these tax-efficient supply chains, i.e. produce in Ireland to avoid paying US corporate income tax. So you have gigantic quantities, not big quantities physically, but value-wise, crazy numbers of pharmaceuticals coming into the US in the first quarter and so forth. That turned out not to be necessary because pharmaceutical companies are doing deals. Who knows quite what's going to happen with those deals? Maybe there'll be more fill and finish. But the net effect was you had these giant swings and distortions with no actual tariff being imposed. When you look through that, imports are not really down. And when you look further through that, I think you'll see that imports in some sectors that have been heavily tariffed, like autos, are a little down. And then imports in sectors that are tied to capital expenditure in data centers and so forth, and which have not been heavily tariffed, are up and up a lot. So the aggregate will mask a lot of different stories, but we're not currently trending towards a smaller deficit. I think there's a lot of reasons for that, one of which is that a big boom in capital expenditures normally pulls in imports. And we still rely on imported chips. The build out of TSMC in Arizona has taken time. And so, you really are seeing big increases in imports in those categories. And I fully expect that to be the dominant theme of the second half in the trade data once we get the data. Just on this reallocation, for a firm like Apple, the fentanyl tariff, which used to be 20% and now 10%, that was hitting them because the fentanyl tariff didn't have any exclusions. For the reciprocal tariff, which was the tariff on everybody else, you had an electronics and semiconductors exclusion. Now, that electronics and semiconductor exclusion did not include game stations. Kind of weird and arbitrary and where you draw the limit. And that's true across the board. So Apple's mitigation strategy would have just be get out of China. For some others, your mitigation strategy was initially to go to Southeast Asia because it was much lower, 10, than on China. That mitigation strategy may not work as well going forward. And your next mitigation strategy is final assembly in Mexico or Central America, where you have very strong exclusions, presuming that the USMCA renegotiation doesn't change things. To me, one of the surprises, though, is that in the macro data, you would think all this policy uncertainty would have had a bigger impact. And you really just don't see the policy uncertainty impact yet. But it really has made life difficult for a lot of firms. I mean, it's made life difficult for a lot of analysts. I always put a star next to these estimates of the effective tariff rate because some stack, some tariffs don't stack. There are exclusions, there are rebates. It has become insanely complex.
Anna, I guess all these things always have to come back to the Fed. You said yourself their model for thinking about things and the effect of tariffs was sort of broadly holding up. The fact that consumers are taking about a third of this on the chin, and then you're seeing the rest in various ways in corporate America, but it's not really as obvious because there's so much stuff going on. Does that affect how they might be thinking about inflation coming down the track? I mean, one thing I heard you say was maybe this isn't a lagged effect. We may have seen most of what we're going to see. Is that right?
Yeah, I think what we are seeing right now reflect well one of the model's forecasts. It's not the same result as what the Fed's research has been saying earlier this year, but it matches the result of one particular model from 2018, which is most of it would be absorbed by firms, and hence the hit would be on the labor market. So at the end of the day, the U.S. economy is mostly a service-driven economy. You look at the CPI index, about 3/4 are services sectors, only a quarter is goods sector. Also, if you look at it from the income perspective, 2/3 of the U.S. is labor share. The rest is capital share. So what will happen to inflation in the next 12 months, importantly, will be driven by the labor market. And there are so many things that's hitting the labor market aside from tariffs. There's also the issue of, is AI reducing hiring, which is another almost as big as an issue, as a driver as tariffs. And my answer to that is I think both tariffs and AI point toward the direction of a major drag to the labor market. If I were the Fed, I would be more worried about downside risks to the labor market.
All right. So my takeaway from this is, just because we did promise we would sort of answer those riddles that I posed at the start, or questions, households we see and hear people talking about affordability and the high cost of things. They are clearly feeling the pain, and some of that is about tariffs, but there's an awful lot of other things that are affecting their costs and their outlook. Corporate America paying about 2/3 of the tariffs. It's not being paid by foreign exporters, but there's so much other good news in corporate America now with AI and other things that the bad news associated with tariffs is literally getting lost in the mix. So I guess my takeaway is that tariffs are a lot easier to talk about than to find in the real life economy. Anna Wong, Brad Setzer, thank you so much.
Thank you.
Thank you.
Thanks for listening to Trumponomics from Bloomberg. It was hosted by me, Stephanie Flanders, and I was joined by Brad Setzer, Senior Fellow at the Council of Foreign Relations, and Anna Wong, Chief US Economist for Bloomberg Economics. Trumponomics was produced by Summer Sadi and Moses Andam with help from Amy Keane. Sound design was by Blake Maples and Kelly Gary, and Sage Bowman is Bloomberg's head of podcasts. And to help others find us and enjoy us, please rate and review it highly wherever you listen to podcasts.